Thank you all for tuning into the Innovator's Playbook podcast. I'm your host, Seth Narayanan, founder and CEO of Telient Systems. In this episode, I'm excited to welcome Ryan Ridgway, founder of Cirrus Capital Partners. Ryan is a seasoned investor and an innovator whose career spans finance, technology, and venture investment. With deep experience supporting high-growth startups and navigating the complexities of capital markets, Ryan brings a unique perspective to entrepreneurial strategy and future of innovation. His insights blend real-world execution with a forward-looking view on AI and transformative business models. So Ryan, very excited to have you. Thank you for joining the Innovators Playbook podcast.
Absolutely. Great to be here. Thanks for having me on, Seth. Good to see you again.
Thank you. Yeah, same here. So we met at the Inc. 5000 conference where I was and where you were checking out all the innovators out there. So good to see you and meet you there. I would like for you to give a quick overview of your background. You've held a variety of roles, starting out in sales and then becoming an entrepreneur and then now an investor in a lot of technology businesses. So could you provide some insight and background of your journey and how you got to your current position and role in Cirrus Capital?
Absolutely. Yeah, I'm happy to. I think the key word there is journey. My background is a bit atypical, especially when compared to other folks who operate in the space of private credit, private equity, different elements of finance. I grew up in the Midwest, knew at a young age that I wanted to do something great. Didn't understand for a very long time what that would actually be, but got some helpful cues along the way. I was on track to graduate high school early and actually had 2 years of college already completed through a lot of the advanced placement credits. Continued on and leveraged that and got some additional credit hours at my alma mater, which was KU, but ultimately ended up dropping out along the way in favor of entrepreneurship. It was interesting at the time because I love my parents, obviously, and they raised me as best as they could have with great household and lots of love, et cetera. But they both came from very traditional backgrounds. We're both middle class, W-2 earners, if you will. And that's what I knew when I went to school and started pursuing various classes and credit hours. I was very confused because I knew I wanted to do something big, but I didn't exactly have a well-defined path to get there because I didn't come up through an entrepreneurial household. Then pretty early on in my career, I saw a couple different business opportunities. One of those encouraged me to actually step away and pursue full time. That one didn't work out, which was a frustrating point in my life because then it was kind of like, wow, okay, I'm a young kid still at that age, 20 years old, and I'm not in school full time and this business didn't work out. Gosh, what am I going to do next? And so that what kind of led me to sales. Went on to pursue different roles that are akin to sales development representative, SDR, and account manager type of roles with a number of different companies in the Midwest. And then eventually got my break again, looking at a couple of business opportunities, one of which worked out well in the nutritional supplements category. So I sold that to another franchisee. It was part of a franchisee type of model. And as a catalyst, by accident along the way, and by proxy of some of the relationships that we had built, a gentleman approached me and he said, hey, have you thought about bringing financing opportunities to other entrepreneurs in your network? And I said, not exactly, but sounds interesting to me. Let's snag lunch and see if there's something here. So that gave way to my largest business to date, which for folks in and around the finance or commercial finance category that might be familiar with lending platforms like a Lendio or Fundera, we had a model very similar to that, competitive to them, scaled it up and actually converted it into more of a direct lending, private direct lender over time for small business loans. And fast forward to today, transition from small business lending slightly up markets, and I would also say adjacent from traditional businesses into the land of innovation lending and the broader innovation economy as an extension of companies Cirrus today. A lot of the companies we're helping probably raise some equity along the way, or they are in the process of doing so, or might in the future. And they're probably planning to grow much more quickly than that of a traditional business. But we're helping or non-dilutive capital to help them in their journey. Throughout the process, I've been a hobbyist angel investor as well, have gotten to see some really unique opportunities as a credit facilitator and an investor. And I think as a byproduct of that, you get curious and you want to put your own money to work and have come in on both sides of the capital stack there. So that's probably more than you bargained for there. But
No, that's very interesting to me. One thing that caught my attention was when you dropped out of college. If I had done that back years ago, like your parents, my parents would have committed me somewhere, I guess, in an institution or something. But same thing with my kids. If they had dropped, that reaction would not have been positive. Do you guys talk about it with your parents and they come to terms with it? Or do they still feel like maybe you should have completed your degree? I mean, do you think it helped you propel more because you had that chip on your shoulder that I'm going to prove it to everybody? Did that factor in?
I think it definitely did. In hindsight, everything's fine. Hindsight's always 2020, right? My sister actually went the complete opposite path and is still finally wrapping up her fellowships in the pursuit of being a very good doctor, but she's on year 13 at this point. So I kind of joke and say she's had enough for the both of us and she's the butch smarts and I'm the street smarts of the family. But yeah, you definitely get some doubts along the way. And the people that can doubt you the most are often some of the closest to you because they are inevitably some of the most unfiltered and they care about you a lot. They're well-meaning and they want you to succeed. So it was a bit painful and pernicious at the time. At the same time, I worked my way into some sales roles and ended up doing pretty well with them. And I was kind of like, well, hey, this is cool. My buddies are spending 60, 70 grand a year in their respective education. And I'm making that as a young guy. And I was like, well, maybe I've got something here. So you can always look back, I think, and say, I don't know what would have happened if it would have been a different journey, but I like the path and where it's led me today.
So yeah, you mentioned landing your initial sales jobs. And from there to your current role in investing and capital, what are some of your skills or core competency that you think played a role that helped you in sales and that is helping you today?
I think there's very close proximity to individuals that are gifted at sales and good founders that know how to run a business. And I think a lot of that translates well into how you operate a business and how much you're going to work for it at the end of the day. And so not every business needs technical expertise. Most do, and especially now, it's going to be very difficult to run a traditional business without someone technically minded, at least third party that can come in and help support you. I know big reason why your firm and other great firms exist to help folks with that stuff. But I do think that it is almost universal that if you're going to run a successful business, at least one that starts to exhibit meaningful scale, you need to learn how to sell along the way, or you need to at least be impassioned where you might not understand some of the acronyms or some of the sales methodologies or anything, but people want to buy whatever product or service or offering you are selling because you are so impassioned and energetic about it and you can no longer be ignored. I think for me, coming up in an environment where I was selling for a living, it helps you realize some of those things a little bit more. It helps you start to think, okay, I'm working for a company right now. I'm running my own respective pipeline and I have a process that I stick to and I have various technologies and resources that I leverage to create revenue. I think that's a nice preemptive staging to go on and say, I could do this for myself and I could do it with another product or service. And there's the impetus behind many great businesses.
Yeah. When you're an investor or a lender of capital, you want to evaluate a business on, is this going to sell? This product that they have, if I were to sell this, would I be successful? So I'm guessing will also play a part in when you invest or when you lend to companies.
Yeah, it certainly does. I think that one element is how sold out and convicted are the founders and the management team to what they're doing. And I think the other factor is you can build a business like that, but if the product or service isn't actually good, you will reach a pause point at some point in the not so distant future. So it's a combination. You have to have the skills and you have to want it and get out there and make the world know about what you have. But at the same time, good products naturally experience organic growth. Otherwise, you're going to have a revolving door business, which is what you don't want.
Google is a big example. I don't know how long was it before they even advertised. That was one of those initial businesses that had the adoption because product was so good, they didn't even sell it, right? So
Yeah.
that brings me to my next question of capital and innovation. Google, like I mentioned, such a success, or Amazon or Facebook, none of that would be possible without capital. And one of the books that I read was from the guy in Sequoia, I think, that invested in Google. Yeah.
Sounds familiar.
Kleiner Perkins. He made the initial decision to invest in Google. And similarly, there are stories, people investing in Amazon and Facebook, without which much of today's tech companies would not have come to existence. I don't know if it would have been possible without it, but without that ramp and without that capital, that innovation would not have been driven. What are your thoughts on that, on the importance of capital in innovation and how sophisticated that capital systems are in the US and maybe in parts of Europe and a few other big countries? And that's
Yeah.
evolved a lot over the last 20, 30 years, right? That was not the case earlier.
Yeah, absolutely. I'll share a somewhat contrarian viewpoint here, but my personal belief and observation is I think most businesses don't need to be and shouldn't be capitalized to a great extent, at least if they're aiming to be efficient and preserve capital and run a good business that spins off free cash and is able to support them and their family and so forth. But those that want to change the world in a big way absolutely need to be capitalized and very heavily, right? And I think that is when you think about the founders, Larry Page and Sergey Brin of Google and Jeff Bezos, et cetera. They didn't set out to create a $5 million top line business and say, oh, great, we're going to go get a nice house in the suburbs and cool, we're going to coast with this. It's that they had this unfathomable drive that nothing was big enough. Another notable example in the form of Elon Musk and all of the companies that he's created. The guy's worth $600 billion now as of a couple days ago. What he's doing is still for profit and in the pursuit of just rapid innovation. All of this needs to be capitalized to such an extreme degree. And I don't think you have to look towards the world's biggest innovators that have made the largest impact. I think you can look well below that as well. And I'll give you an example and something that actually really started to help me think differently at the time. When I ran my previous business, we were a somewhat capital efficient business. We didn't go raise a bunch of equity. We had very few folks on our respective cap table. We used a little bit of lending ourselves throughout to bolster our balance sheet. It was, for all intents and purposes, a typical small business and worked it up to about 10 million historical revenue. Things were going good. And subsequently, when I moved on from that business, I was taking some consulting work. One of the consulting roles I took was under kind of the tutelage of a venture studio out of San Francisco. And this venture studio was started by a bunch of ex-Googlers, folks over at Google who had made good money and stock and kind of cashed out along the way, started a venture fund and studio. I was an entrepreneur in residence for a new fintech that they were launching at that time. And I realized that when I got brought in to be, in essence, a fractional CEO and evaluate this opportunity with them, that I was still thinking far too small relative to where we needed to head. And I learned that because a couple months in, I was talking about some other resources that we needed to pull in. And I was thinking that I was asking for too much because I need this person. I was talking about an expense that was going to be maybe $15,000, $20,000 a month. I was like, well, let's see if they go for it type of a deal because I'm playing with their money at the end of the day. And they said, Ryan, it's fine. Do everything you need. And by the way, we're evaluating this. And if we spend a couple $1,000,000 to find out that it's not a good opportunity, that's totally fine with us. And I was like, wow. They had done that many times before, right? I think they had incubated about 20 different ideas and only chosen to pursue 4 to 5 of them. And the other 15 cost them $1 million or $2 million just in market research and everything to figure out that it's not a good idea and just pass on it. Then subsequently, lo and behold, the 5 that they really took hold and said, okay, the market's telling us this is a really good idea. We're validating it. They went on to become really great 9-figure revenue companies and beyond. But we're going to throw a couple $1,000,000 at this, and probably it's not going to go anywhere. We're probably just going to kill it at some point. I was like, wow, okay. So
That is interesting. I've heard versions of it, but put like that, it makes sense to me. And it would be great to go back and look at all those businesses that had taken that exit. And interesting is that part of the reason they probably also do it is to make sure that they're not passing on opportunities somebody else is going to cash in on, right? So this
yeah,
way they do the due diligence to make sure it's not a hockey stick business, which is kind of related to what you were just talking about, which is AI. And we can't talk about AI. And I want to enter that topic with the thing that's on everybody's minds today, as against maybe 6 months or 9 months ago, which is there a bubble forming on AI, at least for the short term, right? So there's a lot of money, there's a lot of investment that has gone in, and the projections of demand are there. And based on that, there has been investments and there has been build outs for data centers and power needs and all that. What do you see is coming around the corner based on everything, all the tea leaves that you're seeing in the market? Are we heading for a bubble bursting anytime soon?
we'll see some pops, but not everyone will see some pops of these bubbles. It depends on who the audience is. I think when you look at other bubbles that have occurred throughout history, you had the dot-com bubble, you had, I guess, 08, 09 was more of a housing crisis, but it was kind of driven by a bubble-esque type of frenzy, at least in the mortgage realm. Money was flying and controls were kind of being put to the side, which is typically where bubbles kind of come from. I think contrarily to those, AI, quote unquote, bubble is really just impacting some of the biggest publicly traded technology companies in the way of how they impact the everyday consumer, right? And so if you look at your portfolio on whatever TD or Schwab or whoever it might be, you say, okay, I'm going to buy the S&P 500. You have the Magic 7, and there is a pretty big concentration there that I think is ripe for a little bit of pullback. But I think personally, my belief is that whatever pullback could greet us in the near to midterm future would probably be less severe than that of the dot-com bubble or the housing crisis of 08, 09, where you're talking about things that are much more ingrained in the normal American household. The thing that has me thinking about this is most of the AI companies that are having equity dollars funnel into them are privately held. So the cap table is in the form of a few select individuals, namely the management team, as well as their early investors, which might be a few VCs and a few high net worth individuals along the way. Do I think they will see a correction? I think absolutely. That's my personal belief. Every company, almost every company that I or we evaluate for credit oriented deals that is not just a traditional small business or manufacturer or whoever they might be, any innovative company is either building on AI, and that is their premise, right? And so we're utilizing AI for matching people with boating and water sports, or we're using AI to get the best dog walkers out there, right? All of these little niches are developing something using AI or applications thereof as a base layer. So you're either doing that or you have a somewhat more traditional business. It could be a home services business that is in some way leveraging AI to become more efficient within your own business. So I think that those applications where you have a business that would in any other timeline be doing well, a pool installation company or a commercial window cleaner or someone who manages your security at your company and for all your computers and your devices and stuff. I think AI is the layer that really helps them excel and grow faster than they would have. I think there's a lot of efficiencies taking place, and those are not going to go away. I do think that AI specific companies are overvalued in most cases from what I am seeing and what I'm predicting, and it will either lead to a setting, there's a few different outcomes for these companies. One is consolidation. They could actually see a pretty good liquidity event if they have someone big that scoops them up while the iron is hot. The other outcome is failure, a corporate bankruptcy proceeding, and just it didn't work out. And the other outcome that I think could be the case for a good portion of the middle layer is going to be something in between where there is some sort of liquidity event, but it really is going to be a let's get something so that we don't get nothing type of events. In that spirit of consolidation, I think the acquirers and those that are flush with cash and who have innovated for decades are going to be in a good position to come in and get these pieces of tech that are really cool that might be overvalued today. It doesn't necessarily mean the tech is going away. It's probably going to be repackaged and repurposed to some extent.
The tech is here to stay, but what form it takes, what applications are successful, how they are implemented, and which of these companies are going to make it is to be seen. Longer term, I'm assuming there is going to be a huge impact. It's probably the analogy is similar to what happened with the invention of cars in the horse and buggy environment, right? Which was a definite leap of technology. I don't know if somebody has done a comparative study of how long that took and what kinds of businesses came in and didn't make it and what made it. That would be an interesting study. I would like to see that as a documentary someday, but probably less like Theranos, which had a lot of promise, but the underlying technology was not there. Technology did not match the amount of buzz, hype, and investment that went into it, and eventually it imploded. I don't think that's the case.
I don't think it is either. I think the technology at its core will stay. Otherwise, I don't think that the biggest technology companies and innovators in the world would be staking hundreds of billions of dollars that Blue Owl and I think Meta entered into, right? But they showed an overlay of Manhattan, New York, and what the size of this data center will be. It covers most of Manhattan, a singular building. And I just can't imagine walking in there, but they're making massive investments. And at the same time, I think there will be a lot of acquisitions. There'll be a lot of consolidation taking place. I just Googled NVIDIA acquisitions 2025. They've made 28 very notable big acquisitions, right? And Meta's doing the same, Amazon's doing the same. And they're the ones really investing massively into infrastructure. So it's getting put to work as a proxy of the demand that has warranted. We need more compute, we need more chipsets. All of this is going to power AI. So it's too big. It's not going anywhere. The winners and losers, I think it's anyone's game, and it becomes less predictable the smaller and smaller the company is.
In fact, today I just saw a news item about Google having come up with their own chipset. I guess it had been in place for a while. It's called TPU, similar to the NVIDIA chipsets. But the key difference was they didn't have the operating system that NVIDIA has, which is that CUDO, I think, is the language that they have for managing it. And Google didn't have it. Apparently, they've just started to invest in that. So I think there is going to be competition to NVIDIA that's kind of coming up. And Apple has its own chip factory now, and Amazon does, and they're all going to get into it. And I think hopefully there'll be some amount of commoditization of AI, right? So AI is not going to become so proprietary that if you win, there'll be a few large winners. I think with all these big players with a lot of deep pockets, I think they're going to make the investments and kind of level the playing field somewhat. Do you see that as well?
Yeah, no, I absolutely. I think it follows a similar journey that a lot of industries follow. We're seeing it right now with, for instance, the legal cannabis industry and what's taken place in California. California has obviously been at the forefront as a leading and innovative state for a lot of vertically integrated cannabis operators and cultivators, fringe businesses that might support them with equipment and grow lights and stuff like that. We've evaluated a few companies within that sector, just we're industry agnostic on who we can support with capital. And the general sentiment is race to the bottom, grow fast enough to where you get on the radar and join forces with someone and realize the benefits, the cost savings initiatives. Otherwise, it's becoming a little bit less margin rich, and it's been very ripe for acquisitions, and some pretty good ones as far as the buyer is concerned sometimes. So yeah, I think everyone wants in. Some don't make it, some do. Those that do, there's probably bigger folks who want to partner up and join forces, and it's just going to be ripe for consolidation.
So you touched on this a couple of discussions earlier, but what do you look for as an investor when you're investing in a new company, whether you're providing capital for growth or capital for operations? What are some of the qualities that you look for in founders and entrepreneurs?
Yeah. So I might have a different answer than most just because we're so focused on the credit side. So I'll give you my credit answer, which is what I focus on day to day. And then I'll give you my answer of friendly hobbyist angel investor. On the credit side, it's much more quantitative. We don't care as much about the management team, their alma mater, their track record. Those elements are a little bit less crucial, I would say. We're going to care a lot more about historical revenue and traction, and the motivations behind an equity investor versus a credit investor are just entirely different. VC is going to go into 10 deals and almost with certainty know that they're just not going to even get close to getting their investment back on 8 of those, right? They could lose everything. And it's what happens the vast majority of the time. They're going to have a couple outlier cases that are big wins, and hopefully one that is a completely outsized case where they earned back 50x to 100x that of their investments, why they do what they do and take big risks that they do and diversify themselves. But, and then credit in those same 10 deals, they want to make sure they're getting payback on it. If they miss one of them, it's like, they don't have 100x or even 10x outcomes. They have 1.1 outcomes, right? So they're taking just a completely different appetite to risk and reward. And because of that, the numbers matter so much more. The debt service and how has the business performed? How do we stack up how it's performed historically versus what's going to happen over this next year? And be along for a good ride the entire time without much exception. Some of those elements do speak to the product and what the company is doing. So it's not all about historical revenue or and profitability.
Right.
In many cases, it is about scale and the ability to reach scale as well. So if the company is approaching 2 or 3 million in top line revenue, and yes, they're growing, but they're already starting to become really inefficient in the way that they acquire new customers, and their churn is increasing and their market size isn't that huge. Those are all elements that obviously go over into equity land as well. And credit investors really care about it because their initial check or facility that they might put in place is hopefully number one, and they can come back again and support them on the upswing of growth and not just be a single serving capital partner for them. And then on the equity side, you have to get a good sense of conviction from the founding team. They have to be in it and they have to be doing something big. Otherwise, they run the risk of early investors wanting to retreat early at the same time when they might be encroaching upon a smaller market size, for instance. There has to be this compounding of returns that makes sense for everyone, and they have to be thinking about it big. Otherwise, if it's not going to be big, you would be best apt to bootstrap it or get some incremental credit along the way. So I think the equity viewpoint is different. You can probably succeed without having this viewpoint just because there's so much FOMO out there for good founding teams and good ideas, but you should want to solve novel and real problems with AI. Otherwise, there's going to be a lot of smaller arbitrage plays that exists out there and a bunch of quick wins. But for me personally, I wouldn't have much interest in solving something super niche.
That's great. What are some of the qualities of leadership that entrepreneurs, founders, and people in leadership need to possess?
I think contrarily to how we like to think sometimes, especially if we have a very analytical mindset or type A, and that's how we operate, which is me, and I have to pull myself out from that. I think leaders should be looking to create other leaders. Someone can be a leader regardless of whether they have other people reporting to them or not. You can be entrepreneurially oriented despite not leading a team and not founding your own company. I think that's a really important element, especially when it comes to innovation economy. You want people who are creative and you want to give them the grace and the bandwidth to develop their own creativity and fall down. We can coach, we can inspire, but at the end of the day, we want to hire people not from a spirit of control, but from a spirit of, hey, we want innovative people that are bringing unique ideas and insights to the forefront. I think it was Mark Zuckerberg. He was being asked about Facebook or Meta now and about some of their core traits and tendencies when they go to hire team members. And he said his was very simple. He goes, when I sit down with someone for an interview, I ask myself the question of, could I see myself working for them? And if the answer is no, then it may or may not be a fit. If the answer is yes, that's usually a good key indicator that they'll be wonderful for the team. And that's pretty powerful because you think of Mark Zuckerberg and you're like, gosh, there's this guy who's just seen immense success and he must know everything, but it's not him. It's him and his team, right? That they've very tactfully assembled over many years. And it's so much bigger than just himself and his wife and his family. So I think that's an important one. The other phrase that I've used a bunch within this same realm is you can't push a rope, but you can pull a rope. So what happens if you have a rope and you try and push it? It's going to go all over the place. It's going to be wonky. It's not going to work. If you pull it, it'll come right alongside you. So how does that translate to a human persona? If you push people to do things, it's oftentimes your idea, but might not be their idea. And it will probably work, albeit inefficiently. But if you pull people towards a certain mindset and a certain level of conviction and give them the room to figure out how to do it in the best capacity over the long term, it's probably going to pay you better dividends. They're going to feel like they have a better home and a better working relationship with
And
you.
I show them maybe by example. You do it and they follow you and learn from that. That's great. Anything else on leadership?
Be patient.
Yeah.
Someone said one time to me, businesses are really easy. People are really difficult. And inevitably, if you want to scale a company, leveraging AI, automations and tools along the way, you're probably going to have a team with you. That team is probably going to be pretty diverse. Not everyone's going to think the same way. Everyone responds differently, and we're all human at the end of the day. So I think creating an environment as a leader where people feel that despite their differences, they have a good respected platform to talk about similarities and differences and how they control certain outcomes and what their ideas are. These are inclusion in that way, I think, is really important. And listening, making sure you always listen more than you speak.
That was going to be my next question. That's also advice, not only for leaders, but also for the upcoming generation. You've had a lot of success in a very short time. I think you have taken chances, taken risks, and established yourself in a very impressive way. What would be the advice that you would give to the next generation? Should I drop out of college or not? No, I'm just kidding. What are some of your key advice?
Yeah, I would say be okay with change. Try not to be too frustrated with change, because the older you become, the less frequent you reinvent yourself, but you will reinvent yourself along the way. Perhaps entering college, having very well-defined idea about the person you are and where you're going to be 5 years from now. And I'm going to live in this area and I'm going to have a wife and do this for sure as a career and all these things, right? And then you find out that when you're 20 and you're looking 5 years down the road, you're looking 25% of your life in the future. And you will probably change along the way and will probably have both internal and external stimuli that shape where you go and who you end up becoming as a person. And then maybe by the time you're 25, maybe you do the same again in the next 5 years. Eventually, you start to fall into your groove and who you are and reinvent yourself. But gosh, if I had a crystal ball that showed me the future at certain inflection points in my life, I probably would have been shocked at what I saw on the other side, because I'm like, what the heck? That's not at all what I envisioned doing. But in hindsight, it all starts to make sense. So I think don't limit yourself. You have no idea the people that you will meet throughout life that started out doing something that really inspired them, but that proved to be a catalyst for something entirely different. Your love for communication and your love for teaching means you might be a really good leader, or you might love to travel and meet people from other parts of the globe, or you might actually be a really good business professional that blends, operates in trade across different cultures. So I think it just goes back to the spirit of be open-minded, be okay to change. One thing that has really benefited me, especially earlier on in my career when I had dropped out of school, I had chronic imposter syndrome for quite some time, because I was like, was that the right decision? I don't know. I'm not making a bunch of money. What am I doing? If you don't know how to do something, say yes and just try and figure it out. If you embarrass yourself a little bit, it's okay. You're probably going to learn a ton in the process. And you find that in many cases, a lot of other people simply are doing the same thing. You're probably not going to embarrass yourself nearly as much as you think you will. So take the risk.
That was great, Ryan. I know I can keep talking to you, but it's almost an hour since we spoke. I really appreciate you coming on. I know you've been traveling, and thanks for fitting this in, and I look forward to staying in touch and learning more about your continuing journey. Thank you.
Likewise, Seth, really appreciate it. And thanks for the opportunity.